Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
Hey, welcome to another edition of Your Money, Your Wealth. Thanks for joining us. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with, of course, the big man. He's sitting right over there. It's Big Al Clopine. He's a CPA. First time watching the show. I'm a certified financial planner. I've been doing this close to 20 years. Big Al has been practicing, helping you with your taxes for about 200 years. So we're going to talk a lot today about taxes. Can you believe it's already almost close to the end of the year? And so this is the best time to think about taxes, because I know we pay a lot in taxes, but if you look at the history of the tax code, we're in almost all-time low rates. Where do you think tax rates are going to go? I think everyone agrees that tax rates can only go one way. So stick around for this episode to figure out ways that you can still reduce your tax budget. So here's what's on my mind today. There's a lot of different things that we're going to get into, but first and foremost, there's two terms I want to explain. There's tax avoidance and there's tax evasion. All right, tax evasion will put you in jail, so we're not going to go there. Tax avoidance is your given right as a U.S. citizen to do everything you possibly can to avoid the tax bite. There's a quote that I want to talk about by a good old judge that he spoke with a few years back. It might have been back in the 30s. And he's basically saying you can arrange your affairs to do everything possible to reduce the tax burden. There is no patriotic duty to pay more money in tax. I'm paraphrasing, of course, but that's the deal. It is our given right to do everything we can to do what we can do to reduce the tax bite. Here's another problem. That's why I want to bring Big Al in, is that the IRS, the tax code, doesn't tell us what we can do. So there's no roadmap to say this is exactly the strategy fit for you. The IRS code tells you what you cannot do. So it's your interpretation of the code to make sure that you apply it to your specific situation to do everything you can to reduce your tax bite. With that being said, let's bring in the big man, Big Al Clopine. How'd you like that quote, Al?
Well, I love that quote, and I think this is maybe going to be one of our best episodes ever, because you think about tax planning, and what can you do to reduce your taxes? And I think all of us would like to pay less taxes. In fact, I have yet to find a person that said, you know what, Al, I think I'd rather pay a few more taxes. No, y'all want to reduce your taxes, and we're going to talk about how to do that on this episode. And now is the best time, really, because about 95% of the strategies you have to do this year. So when you consider year-end tax planning, a couple things. First of all, you have to understand your income tax bracket. You have to see what tax rate you're paying to figure out what strategies are going to be the best for you. And in many cases, even most cases, you want to try to reduce your income to try to reduce your income taxes. But in some cases, you might actually want to increase your income if you're in a low bracket year, and we'll get into when and why. But Joe, I think this is the time of year. I mean, it's Thanksgiving, it's the holidays, but it's also the time of year to make some changes to put yourself in a better position tax-wise.
Well, you know, it's kind of funny. We're talking about tax planning, right? And so you would think, okay, let's figure out some deductions, exclusions, exemptions, tax credits, or whatever that you can do to reduce your overall taxable income. But wait a minute, you said that you might want to increase your income.
In some cases.
And here's the reason why, because the whole dimension of the tax code has changed significantly. If you take a look today with the different taxes that just came about with the new tax bill that was signed in 2013, with the squeezing of your deductions, tax rates went up when it comes to capital gains, your ordinary income. Everything has changed a little bit. So it's not looking in the rearview mirror anymore. It's taking a look at, all right, well, what can I do today, but not ignore tomorrow, 5 years, 10 years, 20 years down the road?
Yeah, I think that's well said. And really, in a lot of cases, what happens is people are trying to reduce their taxes so much today that they actually want to, they're going to be in a higher tax bracket later. And so you have to consider multiple years of taxes, not just 1 year. But let's start with how the tax brackets work. And I think we have a slide as to brackets. And this is married filing joint. And what you can see is from your first $0 to $18,000 of income, you pay 10% tax. Above that to $73,000, you pay 15% tax. we have a marginal bracket, which means no matter what bracket you're in, you will still get the benefit of those lower brackets. So look at that $73,801. That's the start of the 25% bracket. If you make $73,802, it's only $1 taxed in that 25% bracket. This is what accountants call marginal bracket, and it's important to know your marginal bracket because when you're adding income or you're deducting income, that's going to be your detriment or your savings. If you're in a very low bracket, you might actually want to increase income so that you're not in higher brackets later. But in many cases, you're in a high bracket, you want to go just the opposite.
Right, you want to take a look at what tax bracket that you're in to determine what type of tax planning is appropriate for you. And so looking at those brackets, going back to your tax return, you can say, all right, looking at line 43, second page of your 1040, that will tell you what your taxable income is, line 43. Then you could say, all right, well, this tells me what tax bracket that I'm in. Am I in the 15, the 10, the 25, the 28? Did I fall into alternative minimum tax? And that's a whole different topic, a whole different show. But there's ways then that you could say, do I want to increase my income this year or do I want to decrease it? Let's talk about decreasing your income, Al, and figure out some strategies of what people can do now, I guess, for the next 4 or 5 weeks that they still have a little bit of time.
Well, I think that's important. I think that's what really most of us want to learn about is how to decrease our income. So let's get into some of those strategies. So number one would be make sure you're maxing your 401k or 403b, whatever kind of employer plan that you have. The total is $17,500 this year or $23,000 if you're 50 years and older. You only have a couple months left, but try to max that out, or at least as close as you can between now and then. You may have to change your payroll deductions, maybe go to HR to make that change. Here's another one. You might be getting an employee bonus, and you might ask your employer, can you defer that bonus to January so that you don't have to pay taxes on that this year? So that's a second thing that you can do. Now another one, let me go to my list here, would be if you have appreciated stock. And
right, so you want to look at tax loss harvesting. And if you have mutual funds, here's a pretty big deal this year because if you look at the stock market over the last several years, there's a lot of gains. And these portfolio managers inside your mutual funds have been selling stocks at gains. We're going to see a lot of taxes on individuals' tax returns because of how mutual funds work and how they're taxed. So you might get hit with a huge capital gain tax this year. So some of the things that you want to take a look at is if you have losses in other positions, other stocks, bonds, mutual funds that might have gone down in value, you might want to sell those positions to create a capital loss to offset that capital gain, so to zero that tax out. This is a huge deal. You still have some time. I know the markets have done pretty well, and I know all of our viewers, they're great stock pickers and great mutual fund pickers, but if you do have a dog or something that has gone down in value, you want to make sure that you take a look at selling that, because what that's called is tax loss harvesting. You're selling some of those assets to offset the capital gains that I know is going to hit a lot of your investments coming up here on April 15th. It's too late. You've done your taxes. You're going to see this huge capital gains tax, and there's nothing that you can do. So you've got to get it done before year end.
Yeah, and I think a lot of people don't realize that when you have a capital loss, it offsets against capital gains dollar for dollar.
Yes, so it doesn't matter if it's short term or long term.
Right, right. So that's very effective. I want to just quickly touch on another one, which is charity, charitable contributions. Realize that you have to make your donations by December 31st for them to be deductible in this year. But here's a couple things that you may not know. You're allowed to donate appreciated stock, which means maybe you bought a stock at $1,000, now it's worth $10,000. You donate that stock, you get a $10,000 deduction, what it's worth today, but you don't pay any tax on the gain. And there's also this account called a donor advised fund that allows you to take future year contributions and deduct those this year. You put money into this special account, you take the deduction this year, you let it grow for as long as you want, and then charity, you give it to charity later on as you want to.
It's a big deal. There's a lot of different things that you can still do. You still have time. So if you have stocks, bonds, mutual funds outside of your retirement account, and you will get kicked out with capital gains, interest, dividends. You want to make sure that you look at losses to offset those gains. If you're giving to charity, give to charity before year end to get that tax deduction on your tax return this year. It's going to help you quite a bit. We're going to take a short break. When we get back, I'm going to draw a couple of things out just to look at a case study of how much money that you can actually save in taxes just by doing 2 or 3 of these things that we just mentioned. So don't go anywhere. The show's called Your Money, Your Wealth.
I'm Matt Horsley, Certified Financial Planner with Pure Financial Advisors. Did you know if you retire today at age 65, your healthcare costs are likely to be roughly $250,000 in total? That's roughly $13,000 per year throughout your retirement.